Inside bars are the opposite of outside bars, since they form totally within the trading range of the previous bar. An outside bar indicates a strong reversal in sentiment. An inside bar, on the other hand, reflects more of a closer balance between buyers and sellers, following a sharp up or down move in which one or the other previously dominated. In this diagram we see a rally in which buyers are very much in control. It accumulates in a relatively wide bar. However, the trading range of the next bar is totally encompassed by the first. This second bar is the inside bar. During the period in which it's formed, buyers are unable to push prices to a new high. For the first time during the rally phase, some momentum appears to be lost on the buy side. By the same token, sellers have not yet taken over, since they're unable to push the price below the previous bar. In effect, the balance between the two parties is very close, as neither is in control. Such action is often a subtle indication that the prevailing trend is about to change. Since inside bars do not reflect such an obvious reversal in sentiment as their outside counterparts, these patterns are often followed by a small trading range, as opposed to a reversal in trend. This trading range is characteristically followed by an actual trend reversal. At other times, the inside bar is followed by an immediate reversal, as we see here. Unfortunately, there's nothing that tells us which of these two outcomes will take place ahead of time. An example of an inside bar at a market bottom is shown in this diagram. Once again, the sellers are in control as the price declines. But as the inside bar is forming, we have a stalemate, as sellers cannot push prices lower, and the buyers are not strong enough to take the price above the trading range of the previous bar. In this instance, the inside bar is followed by a trading range, and this in turn gives way to an eventual rally. Remember, inside bars are only expected to have an effect for between 5 to 10 bars, so a trading range of this length could just as easily give way to a renewed decline once it's over. The following factors offer a rough guide in trying to assess the significance of an inside bar. The sharper the trend preceding the pattern, the better. In this situation, the inside bar on the right is the stronger signal, because it's preceded by a sharper trend. The strong trend indicates the dominance of one side or the other, and is the setup for the reversal. If neither side were in control, sentiment would be indecisive, and there would be nothing to reverse. For example, during a sharp rally, many traders have large paper profits. When they sense a reversal, it's an easy decision to cash in on those profits, rendering the price vulnerable. The opposite would be true for short sellers following a decline. If the inside bar is not preceded by a worthwhile move, this motivation will be absent. The wider the first bar and its immediate predecessors in relation to the previous bars and the inside bar, the better. That makes the inside bar on the right a better candidate, because the noticeably wider bar indicates that the prevailing trend is reaching a climax. An extensive trading range within a bar indicates volatility, and volatility is often a precursor of a trend reversal. Also, at the mature stage of a strong trend, wide bars indicate the probability of exhaustion on the part of those pushing the trend. When followed by a substantially narrower bar, this suspicion is confirmed. The smaller the inside bar relative to its predecessor, the more dramatic the change in the buyer-seller balance, and therefore the stronger the signal. Not all inside bars are created equal. Remember, this pattern gains its importance by contrasting the change in the balance between a buyer victory and a standoff, when no one is in charge. Consequently, if this inside bar is changed to this one, which has a much smaller trading range, the contrast is that much stronger, and so is the signal. Volume on the inside bar should be noticeably smaller than that of the preceding bar, since it indicates a more balanced situation. If we see a heavy volume accompanying the bars preceding the inside bars, this indicates great enthusiasm on the part of those pushing the trend. Then, if volume shrinks noticeably, it means that neither party is in control. That's obviously not happening for the inside bar on the left, but certainly a characteristic of the one on the right. Here's a 5-minute bar for the S&P Composite. Right at the bottom of this decline is an inside bar. Unfortunately, there's no way to predict that it would be followed by such a sharp advance. Later on is another inside bar. This one was perfectly good on paper because it followed an advance, was quite small, and so forth, but it clearly didn't work. I like to see confirmation from these formations, and you can see we would not have got one from this trend line because it was never violated. Finally, the best example of all, because it was preceded by a strong advance with ever-widening bars as we reached the top of the rally. Finally, a small trading range in contrast, clearly demonstrating that the buyers were no longer in control. This chart features hourly data for Minnesota mining. Here's an inside bar following this sharp rally, and the end of the ensuing decline was signaled by another inside bar. I put it in quotes because the high was pretty well identical with that of the previous bar. So it wasn't, strictly speaking, an inside bar. But I don't care because it still shows an even battle between buyers and sellers following a brief period when sellers were in control. Later on we see another inside bar which signals a slow return to confidence following a sharp decline. The gap in the sharp rally were obviously caused by some good news, but the next inside bar signaled that a period of profit-taking was in order before prices could move higher. Finally, this inside bar was basically followed by a consolidation, although a couple of bars did touch new highs temporarily. Here we see another inside bar, this time for Allstate, again followed by a consolidation. Another inside bar appears after this extremely sharp run-up, and this is followed by a trading range. Note that the price breaks out of the range, but does not hold the breakout. This was an outside bar, and a pretty good one at that, because it violates this uptrend line. The fact that the line was broken during an outside bar adds to its significance. Whipsaw breakouts like this are often followed by above average declines. This example was certainly no exception to that. Finally, another outside bar following a rally that closed on its low. Prices should have gone down, right? Well, in this case, it's followed by an inside bar, and that told us that the sellers were no longer in control as they were during the formation of the outside bar. In effect, the small inside bar cancelled out the effect of the bearish outside bar. Now a daily chart for Amazon, and a nice inside bar at the end of this sharp decline. This trading range also contains an inside bar. I don't think it had that much effect, except to tell us that the balance between buyers and sellers was evenly matched. All the better when this outside bar came along with a trendline break as excellent confirmation. Note the break comes during the formation of this outside bar, a very nice touch. Just to show you that everything doesn't always work, here's a perfectly good inside bar that should have worked, but it didn't, as the price went on to register new highs. I couldn't resist putting in this chart of Canara Bank, an Indian stock. See this great rally with widening bars as it closes in on the high. The signal that it was all over came from this inside bar. Summary of inside bars. 1. 2 bars preceded by a persistent up or downtrend. 2. The first bar is relatively wide. The second bar is totally encompassed by the first. The smaller, the better. 3. The inside bar indicates a balance between buyers and sellers. Signals are of a short-term duration. And 4. They are followed by a reversal in trend or a consolidation.